Okay, welcome guys to this part two of the breakouts and momentum module of the price ladder course. What we're going to be going through now is actually looking at how to identify, how to identify potential breaks. And they could be breakdowns, breakouts. Usually, um, traditionally you would say breakout if it's the upside or breakdown to the downside, but in any case, you could just say breakout for both up and down. What we're gonna actually take a look at is we're gonna try and give you some examples. Um, so we're gonna try and give you some examples of daily range contraction examples. So let's start off with daily range contraction. So obviously we're looking for the range expansion, but we need to first find range contraction to understand where to find the good trade location for the range expansion. So we're looking for daily range contraction. Um, and we're also looking for potential stop zones. Where are the stops? Where are people having their stops? Where are the long-term buyers and sellers placing their stops? Because from a short-term perspective, we can identify these areas. We can have very nice short-term opportunities where the market has swift flow as it gets through these major areas. And we're going to look at major swing highs and lows. We're also going to look at something called a cascade of stops, which usually we get near trend lines. And then we're going to look at something called one-time framing. Right. Okay. So just bear with me. I'll pull up the charts real quick. Hopefully you guys can all see these charts that I've just pulled up here. And we're going to be looking, as we've been looking a lot at the Bund futures, we'll just keep it very simple and look at a Bund chart, a Bund futures chart. This is applicable to pretty much every market, so it doesn't really necessarily mean just because it's this market doesn't mean it's going to work on other markets. Other markets have different price action characteristics, but in the scope of this course, we're going to try and keep to something that's not too thick or too thin. So the Bund I thought was a perfect product to try and read from a price action perspective. We'll look at the chart of the price of the Bund, and we'll take a look at some of the things we just talked about. So we're looking for daily range contraction. So within this chart, as you can see, the market's gone through various cyclical patterns of volatility, and it's gone through various phases of high volume and low volume. So you could see all the volume on the lower end of the chart. So you could see this is what's considered as probably lower volume. Somewhere in between here is probably our average volume. I haven't actually dotted that in, but you can actually get the average volume up. I won't waste the time in doing that now, but you can see very simply this is characterized as low volume. We've got this characterized as high volume. And usually, as you can see, the higher volume is correlated with range expansion. So this is range expansion, and an example of range contraction is what you can see in here. So we've got a move into an area. We've got range contraction or consolidation. This is where the market's somewhat consolidated. Then at the break point, in here is where we're getting the range expansion. We're looking for examples of that. So you can see one example is in here. So we'll just make that clear. We've got one range expansion and one range contraction in here. I mean, you can find them almost anywhere. You can find a range contraction in here. That's a double inside day. We have range contraction. If we just try and point out a few more for you guys. We've got range contraction in here. We've got range contraction even in here. There's range contraction in this little area here. Very much in here. So this is very much a range contraction. So that's one example, 2, 3, 4, 5. And notably, I mean, even in this is one little inside day in here. That's also another range contraction. So basically, it's examples of where the market contracts and the subsequent highs or lows are so the highs are lower than the previous highs, and the lows are higher than the previous lows, in which case you're getting the range to contract and get into a range whereby it's trading within that little value area. And then when we subsequently get the pushes through here is when we see a bit of volume. Now, in this case, obviously, we didn't see much volume. The market kind of shifted and then collapsed through that area again. But these are small examples of what you can characterize as range contraction examples. And this is what we're going to be looking for in the chart before we try and position ourselves. This is also another little example right here of a range contraction. And then the push through here is where we get the breakout. So you could see, if you just sit and look at a chart, you'll spot examples of range contraction almost everywhere along the chart. So there's opportunities non-stop if you're very tuned into the price action, tuned into what the market is doing. Now, in terms of, that's examples of range contraction. In terms of stop zones, now, in order to characterize a stop zone, you have to understand, in order to characterize a stop zone, you have to understand where the big buyers and sellers know that they're wrong. Where are they wrong? So we want to find out where the big buyers and sellers are wrong. So if we were to take an example of a market where we know an area in which the market's wrong, at least in the short term, well, a very good example is, as you can see, is probably this right in here, a very recent swing low that we just took out in the Bund. And I think that's a very good one because we recently just had to move through it. And I saw the price action. The price that was very fresh in my memory. It just happened yesterday. It was over the non-farm payrolls. So we had a bigger than expected number. We'll go through how to trade and benchmark risk, but let's just take into account the market had been trending somewhat higher. So we've been making higher swing lows. So this is a swing low. This is a higher swing low. Again, another higher swing low in here. This whole region in here is one swing low. Now, imagine this swing low is made up of a few bottoms. This is made up of one bottom. This is made up of two daily bottoms. This is made up of two daily bottoms. This is made up of one, two, basically 3, 4, 5 daily bottoms. So the market's had a chance of breaking this area many times. You can imagine that below this region, the buyers are going to be placing a large area of stops. There's probably a large area in which the market has placed their stops. Because if the market gets back below here, it has now officially taken out a swing low. And in technical terms, that is no longer, that's the break of the bull trend. The bull trend is sustained so long as major swing lows are higher than the previous ones. And the swing highs are higher than the previous ones. So you can see, even the swing highs, these are all higher than each other. Well, this one was lower, but we made a higher swing low and then expanded up. And this is a higher swing high as well. So these are all swing highs. So in seeing this, we know very well that just below this area is the confirmation that the longer time frame has positioned, the way it's positioned is wrong. And in this case, we were looking for stops below this region of 71s. So basically, that is an area, a stop zone. That's an area where if we break out, and you would have noticed if you were trading this, below these 71s, there was good flow because there was stops. There was good flow because people had to stop out of their positions and they didn't care where they were hitting. They knew they were wrong, so they weren't going to wait until the market got to them. Sorry, let me just try and take that. They weren't going to wait until the market got to them. As soon as they took out this area, they were hitting market. They were quickly executing their flows in one direction, and that's why the breakouts were good. And these are the kind of things we look for, guys. Areas where there's stops. Now, consequently, we also had another phenomenon in this area, what we call technical confluence. And it's something called a cascade of stops. And it's very intuitive, really. It just means, as I just mentioned before, the higher this market trends, so let's just say we made a swing low in here, the market participants are going to start putting their stops below here. That's the first region they put their stops. Then we make another swing low. This is swing low number 2. And then the swing low number 2, once the market starts rallying, the market said, okay, that's another swing low. I'm going to place, then another set of buyers have now put their stop below this swing low. And remember, now the buyers that have put their stop below this are probably now trailing their stop. When I say trailing, that means they move their stop up as the market moves higher. So in essence, they've now shifted some of their stops into this stop zone. So this stop zone becomes a little bit thicker. We see the same thing occur at swing low number 3, where this starts becoming even thicker in this area. Again, at swing low number 4, this becomes even thicker and bigger. So the area of stops becomes thicker. We have more volume of stops, basically more stops that it would be triggered. And in this area, most probably we have the biggest stop zone. And the way I'm drawing this is indicative of just how many stops there are. It doesn't mean this is the area in which the stops are in. You know. So when I say cascade of stops, I mean that as we move up, this is where you have to understand this little concept. This is our trend line. As we move up, the market now increases the stops. So little stops here, then as we move, the number of stops becomes bigger and bigger and bigger. And the reaction through these areas becomes bigger and bigger. And you can imagine as we move higher, the market now has to shift its stops higher and higher. And there's more and more stops that come into the market higher and higher. So these cascade of stops usually happen when we have major trend lines. So in this case scenario, we had a major trend line here. We broke that trend line here, and you can see the reaction. If we just erase a little bit of this, the major trend line came in right here. This was our break, and this was inevitably our reaction. A very similar concept. You could have applied it in this area. Obviously, I did not draw that very well, but let me just try it one more time. I'll try it from here. Damn it. Something like this. So that's our trend line. This is our break. We had a cascade. Surely we had a cascade of stops that looked this, growing as you move higher. And when we finally took that area out, we get the reaction, flows in the market. The market had to cover and move lower. So that's what we would call a cascade of stops, very simply, just to understand that basic concept. Now, one more thing before we move on to something to the more interesting stuff is a concept called one time framing. This is not exhaustive. I'm just going through a few concepts that help you understand where the market could potentially break and see good flow. The concept of one time framing basically means that a market's moving in one direction and it's posting, let's say if it's moving to the upside, so if it's moving to the upside, we're always posting higher swing lows. And obviously we'd have to be taking out the previous swing highs as well. But the main characteristic is that we're always making higher swing lows, and to the downside, always making, lower swing lows. Swing highs, So let's just see where we can point this out on the actual chart here. The one good example that I can spot is this one right in here. Just bear with me. So in this little example in here is where I'd say it's a good example of where we had actually quite a bit of one time framing. So in this here example, we had the market moving up off this swing low. This was our first swing low, so swing low number 1. This was our swing low number 2, swing low number 3, 4, 5, 6, 7, 8, 9, 10, 11. Now, basically, for 10 straight days, the market had made successive swing lows that were higher than the previous swing lows. This swing low is higher than this swing low. This swing low is higher than this is higher than this. And as we move higher and higher, the market continuously makes, like we saw before, that cascade of stops. It's making a cascade of stops. It's now putting the stops below here, then the stops below here, below here, below here, and then they keep moving it below the previous swing low. As soon as you get one of the swing lows taken out, so in this example here, as soon as you get one of the swing lows taken out, on this day, I know it doesn't look like very much, but on the open, when we came through this swing low here, there was really good flow to the downside. That break was very, very aggressive. It didn't look like much, but it was very quick, swift price action. So if you can identify just the fact that we were making these higher swing lows, is some good value in trading that when we finally break that. So hopefully you guys understand some examples of range contractions like we talk about, major swing highs and lows where we would get stop zones, what a cascade of stops would look like with trend lines, and the one time framing concept. In the next part, we're going to look at what to look for on the price ladder for high conviction breaks. We're going to actually try and describe it, and then we'll actually take a look at examples of it on the price ladder again. Thank you very much for listening, and stay tuned.